The early signs of global deflation are out there. If it occurs, it would be catastrophic. Doesn't need to happen, and I'm not saying it's going to. Hi, Warren William here from Smartest Data. Let's get into the US stock market at the current weakness, what it means, and what's ahead. So, okay, these videos are done in collaboration with FINSCREENER. It's an online database which I use to follow US stocks, which I do back testing, construct portfolios, a lot of different functions. So in this video, we're going to go through the current portfolio 37 for this year and also 3 key stocks to look at. So it's the FINSCREENER database. It's simple to use. And if you want to follow me and subscribe to FINSCREENER, the link is in the description below. First, listening to a discussion on interest rates sometimes sounds as if it's a vast, uniform mass. Nothing could be further from the truth. Okay, let me be very clear. Rates have not peaked at the long end. At the short end, yes, they're very likely peaked, okay. Rates at the long end of the yield curve are heading higher, which will push the equity market risk premium higher. The current US yield curve is inverted. This rotate and become normalized. I expect this to occur sometime in 2024. There are signs of global inflation slowing, and this is a positive for the world equity markets and also for bonds. But be very careful. The early signs of global deflation are out there. Global deflation combined with the Ukraine war and another potential war in Armenia would be catastrophic. And it doesn't need to happen, and I'm not saying it's going to happen. So it is somewhat contradictory to the forecast that rates are going to go up. But rising rates are more to do with quantitative tightening and a normalization of the yield curve rather than an inflation call. So that's the distinction which we're going to make. This is important for the selection of stocks into 2024. Simply put, stocks must have a total return, dividends plus price appreciation above 8% at least. More volatile stocks closer to 10% and higher. So that's the line which has been drawn in the sand, the benchmark. There is still a wide expectation that a restrictive monetary stance will stay in place for some time to come. But, and it is a very big but, the very early signs of global deflation are out there. The world's central banks must be aware of this. Keep in mind the lag time of an increase in interest rates and the real economy is around about 3 months. The Fed's favourite inflation indicator, the PCP, core deflator, climbed at the lowest pace for 2 years at 3.9% year on year in August. This, of course, is a very positive sign. This was on the back of the September CPI figure in the Eurozone, which fell 4.3% year on year. In Europe, interest rates are also likely to remain stable for a lengthy period of time, according to the ECB. But this all depends on inflation, and that's the critical thing that we're trying to get across. Okay, so let's talk about 2 major stocks which have been in the news, Amazon and Google. And they've been in the news for the wrong reasons. So Amazon stock fell after formally being sued by the FTC and 17 states. Amazon is alleged to be engaging in anti-competitive practices to protect its monopoly position in the online retail marketing. What can you say? But surprise, surprise. I mean, as expected, the lawsuit claimed that the e-commerce giant's action barred competitors and sellers from lowering prices, overpaid sellers, and prevented rivals from competing fairly. Amazon controls around 40% of the e-commerce business. Thus, this is a huge antitrust case. And then on to Google. This stock is under pressure. Try to think of a venture that Google has launched over the past 10 years, which is actually doing well. YouTube, well, not really. Google Plus, no. Google Glasses, no. Google Fiber, no. Google Nexus, no. And Google Bard, well, maybe give it time. But for the moment, ChatGPT is certainly at center stage, and search is extremely important to Google. Okay, if you think Google's AI potential is underestimated by the market, maybe this could make the stock a buy. Google's Bard chatbox is growing rapidly, whilst OpenAI's ChatGPT growth has flattened. But that's the core, and ChatGPT is much bigger. There's also Google Cloud, so let's see. Okay, so let's go on to portfolio 37 for this week. There are 10 stocks, and tech dominates the allocation with a 50% weighting. The other weightings are 10% being healthcare, financials, cyclicals, energy, and industrials. There's not always a strict adherence to the stocks discussed by the investment committee on the CNBC's halftime report. And this was one of those weeks where I included JP Morgan, Cisco, and Nvidia. Let's go over and take a look at the portfolio construction process, which is a simple 10-step process, all done with FINSCREENER and Excel. Easy to do, just follow it. Way to get discipline into your portfolio management. Okay, let's go over and take a look at the portfolio construction process. A construction process we do each week. It's simple 10 steps, all done in FINSCREENER and Excel. Step 1, simply select the individual stocks to be included, US stocks, and then also selectively ETFs. Step 2, measure the market cap of all the stocks in the portfolio and their price. This is done via FINSCREENER. Step 3, aggregate the market cap of all the individual stocks for a total market cap of the portfolio. Step 4, calculate the percentage contribution for each stock. So take the market cap for each stock and divide that by the total market cap, gives you a percentage contribution. Step 5, estimate the individual allocation for each stock. Okay, so what we have is the percentage contribution, and then we adjust that. So if you've got Nvidia in a portfolio, so a trillion market cap company, and a small cap stock, it's not dominated by Nvidia. That's step 6. So a mega cap stock can have between 20% to 15% market cap. A large cap stock, 10%, mid cap stock, 5%, and ETFs will always have 5%. Step 7, based on the initial investment, calculate the allocation to each stock. Step 8, which is the initial allocation, it's a pro forma, not real, amount of $1 million. So step 9, we determine the number of shares. Step 10, divide the allocation by the current share price, and that gives you the number of shares in the portfolio. Okay, the 10 stocks included in portfolio 37 for 2023 are the following. First off, Nvidia, technology, Nvidia. Second, JP Morgan, finance, JPM. Third, Adobe, technology, ADBE. Fourth, Cisco in technology, CSCO. Fifth, Abbott Labs, healthcare, ABT. Sixth, Nike, consumer cyclicals, NKE. Seventh, IBM, technology, IBM. Eighth, Palo Alto Networks, technology, PANW. Ninth, FedEx Industrials, FTX. And 10th, Shanine Energy, LNG. Okay, so once the portfolio is inside of my portfolio, is inside of FINSCREENER, we can take a look at the various asset allocation. So as we can see here down on the diversification, 50% into technology, and the other 5 sectors, healthcare, industrials, financial services, consumer cyclicals, and energy, take up the other 50%, equally weighted at 10% each. Then we can take a look at the earnings ratings from the analysts. So one on a strong buy, which is Nike, one neutral, which is the energy company, and then after that we have 7 stocks on a strong sell. We get down to stock allocation, and we can say Nvidia there at 20%, and the allocation to all the other stocks, only stocks in this portfolio, so that's 100%. If we look down at the diversification and the correlation, you can see FedEx is quite a diversifying stock in the portfolio. If we look at the various sectors, as we say, healthcare, click on healthcare, Abbott Laboratories, technology, we have 5 stocks, IBM, Palo Alto Networks, Adobe, Cisco, and Nvidia. Then we go down to industrials, 1 stock, FedEx, energy, Cheyenne Energy, financial services, JP Morgan, and consumer cyclicals in Nike. The stock with the greatest upside at this point in time, as we can see here, we go down the list, and it is actually Nike with the greatest upside. And so that's it. Let's go on to Access and how we fill out our database. Okay, so here we're inside of Access, and Access is a fundamental way to measure our investment universe of stocks. Okay, so it's not an individual portfolio. We don't have 160 positions. No. We're looking at having a focused portfolio of, say, maybe 10 to 15 positions. But this is a selection universe. This is all the stocks that have been recommended or that were put in the individual portfolios as we've gone through the year. So I think we're up at about 160 stocks. Inputting is the same way. So we take the market cap and the share price. We look at the number of shares, and that's how we go about it. Then we can go back and see when we've invested in stocks or recommended stocks in the past and how the relative performance is going. The stock index at that point in time, the entry price, and a certain point in the future, the stock index, and also the price of the stock at that point in time to see if stocks have outperformed the various indexes, NASDAQ or QQQ. They're the basic ones we use. So that's it. That's what we're doing here in Access. Then on to the last step, which is our watch list. So all the stocks go into our watch list. That's what they update first. And all these stocks are inside of Access. And also don't forget, you've got the email notifications via FINSCREENER, so you can watch what are hitting 52-week highs, 52-week lows, dividend announcements, etc. It's a very useful way to keep track of your stocks. So once you enter a stock inside of your watch list, you'll get an email notification of what action is going on with that stock. Okay, so let's go over to the top 3 stocks for this week. JP Morgan, JPM is the ticker. It's a 423.5 billion market cap company, currently trading around $145.70. Solid balance sheet amid troubled financial sector and sound growth prospects. That's the story for JP Morgan. Net profits and stock performance improved after acquiring First Republic. Rising revenue and potential recovery in financial markets leads to the potential for above average returns. Strong cash flow, solid fundamentals, JPM will likely boost dividends. Q2 earnings exceeded expectations and showed strong fundamentals despite rising interest rates and geopolitical concerns. The company is seeking EU expansion and opportunities in India. JP Morgan is inexpensive and well positioned to endure commercial property loan deterioration and significant bank downgrades. Over the past 12 months, the stock is up 35%, year to date up 8.7%. Okay, so here we're inside the back of FinScreener to take a look at JP Morgan. And as you can see from the graph here, it's been tracking down along with the overall market, so nothing untoward there. And it's starting to move a little bit sideways. Okay, so let's take a look at some of the valuation parameters. First off, purely valuation with the PE ratio. Current PE ratio is on 11.6 times. And as you can see, it's much better than the S&P, but don't be fooled by that. The banks do trade on a discount to the PEs of the overall market. So if we look going forward, you can see here, the P of 9.87 times. So that is quite reasonable considering there could be quite a pickup in growth regarding the financial markets and the overall economy. Remember, if the US economy slips into a little bit of recession, the banks will lead the economy out. They should have done it earlier this year when the economy was moving, but we had the banking crisis. Looking at other aspects, so if we look at the ROE's sitting at around 9.17%. Okay, that's down as compared to historic values, but there's been a lot more pressure on bank capital preservation. Other aspects regarding revenue, for example, here we are with the long-term revenue growth of around about 3.15%. Not really good enough. It's likely to be that coming up. So there we are. That's JP Morgan. Let's go to the next stock. So to Cisco, the ticker is CSCO, a 217 billion market cap company, currently trading around $53.60. Cisco announced to acquire Sputnik for $28 billion all-in cash deal. Sputnik is a cybersecurity company producing software for searching, monitoring, and analyzing machine-generated data. Cisco's balance sheet is sound post the Sputnik deal. Dividends and share repurchase should continue even at a higher pace. The company's reported solid fiscal 2023 results so far, and assuming moderate growth rates, the stock is still undervalued. Over the past 12 months, the stock is up 32%. Year to date, up 12.6%, so it has lagged tech. Forward PE of 14.4 times, current PE of 17.4, price to book of 4.9 times, price to sales of 3.92, and also price to cash flow of 14.6. Let's go over to FINSCREENER and take a look. Okay, so here we're inside of FINSCREENER for Cisco. And as we can see, okay, the stock has traded down a little bit, trading sideways for the moment, but Cisco has not participated in the stock rally for tech stocks. Okay, so let's take a look at some of the valuation parameters on Cisco. If we move down here, we can see the current PE ratio is at 17.4 times, and the forward PE ratio is at 14.4 times. This for a tech stock is way undervalued. Now, there are reasons for Cisco. It's not in the AI such as NVIDIA, but nevertheless, I mean, Cisco is actually what I consider to be an undervalued stock at this point in time. Let's take a look at some of the other aspects. So the ROE over the past 5 years, the average has been 12.8%, so not fantastic compared to the other parts of the tech sector, but you can see it's sort of picked up recently. So Cisco could be a good opportunity out there. Just as far as various financial strength ratios, there's not a problem with the Cisco balance sheet. That's why they were able to do the acquisition, an all-cash acquisition. So that's Cisco. Nike, the ticker is NKE. It's a 145.3 billion market cap company, currently trading on a share price of about $95. Nike announced Q1 2024 results ahead of expectations. The revenue was $12.94 billion, a 2% rise to the previous year, but it fell short of projections by around about $62.1 million. Nike's stock price has been under pressure, thus the 8% increase post-results was welcome. Converse and North America both performed poorly, while China, Europe, Middle East and the African territories performed exceptionally well. This is important. Over the past 12 months, the stock is up 10.7%, year to date down 18.6%. The forward PE of 22 times, current PE ratio of 35.1 times, price to book of 12.6, price to sales ratio of 3.2 times, and price to cash flow of 74 times. So it's not cheap. Let's go to FINSCREENER and take a look. Okay, so here we are inside of FINSCREENER for Nike, and as you can see, the Nike share price has been under real pressure. So Nike is more of a speculative buy in the consumer discretionary, but there are aspects of the stock's business which are going quite well, and that is Europe, China, and some parts of Africa. Okay, let's take a look at some of the valuation. This stock, got to tell you, is not cheap. So we can see that at a PE, current PE ratio of 30.5 times, and you can see that's right up there with the top valuations in the market. If we look going forward, it's basically 22 times for a forward PE. Again, it's the same sort of thing. So this stock's not cheap. It's a sort of more, can they get more out of their businesses? The States with Converse and the North American market did not do well. Let's look at, say, the ROE. As you can see with the ROE on the stock, the average over the past 5 years has been 23%, and the last 12 months, 38%. So that's Nike. Okay, so that's it for this week. If you like these videos, like and subscribe, and also don't forget to subscribe to FinScreener and makes your investment a whole lot easier. And also the online brokers, so eToro, FX Primus, and First Trade. So that's it. As I said, that's it for this week. See you in the next video. Good investing.